we're going to start with a couple of polls, actually, before I go into this masterclass. And so if we can have the polls up, and if I could ask the participants to take a few seconds to answer those polls, that would be very nice. And we'll share the answers to everyone in the room. And that will just give us a better sense of what's going on here. Okay, so thank you. I can see the answers coming up. Okay, so mostly as individual investors. And kind of a mix in terms of the investment choices that you make between active being a very broad umbrella of investments, and passive. So those are interesting answers to keep in mind as we go through the talk. I'll maybe give another few seconds just to make sure we've got a good set of answers, but that's about, so 90% of people who've joined us tonight are individual investors, or either investing on your own or delegating it to professionals. And in terms of your investments, you're about split 50-50 in terms of what you mostly invest in terms of asset class. Okay, thank you. So let me start off with this presentation. And again, thank you to KFAS for this opportunity to be here. So I'll start off with a quote with a very famous investor, Howard Marks. We may never know where we're going, but we better have a good idea of where we are. And I think it's a very apt quote for the days that we live in. It's actually not that easy these days to know where we are, especially when it comes to investments. And so where do we stand? What are the facts about investing that we should all keep in mind as we go ahead and decide how to invest our savings, whether it's for retirement, whether it's for our children, whether it's as a portfolio manager, as a delegated investor on behalf of other investors. And so I'm an academic, and so I'm going to kind of take a step back from the literature, the day-to-day noise, if you will, the Squawk Box on CNBC and others. And I'm just going to focus, a lot of my slides actually will cite and rely on academic research, which I think is really important if we're going to have a serious discussion about what works and what doesn't work. You and I, we can all pinpoint, we can always find examples of something that worked in any investment class. Okay, so we're going to try and get away from just cherry picking perfect examples and just see, well, what's the broad-based evidence? What is the academic literature telling us? There are thousands of academics around the world working on these topics, and they've done that for many years. And some of the results, I think, are starting to be pretty compelling. So let's go. And let's start off with a few facts. So fact number one, most market gains actually occur over a few days in the year. I don't know if you knew that, but that's certainly the case, and there's academic research to back that claim. In some cases, it's somewhat predictable, not necessarily the direction, but the day where things will move. For instance, an FOMC meeting, so a central bank meeting. Obviously, whatever they decide in terms of interest rate policies and other macro policies will affect a broad-based set of firms, and so you could expect those days to matter quite a bit. Others are less predictable. For instance, vaccine news today, last Monday, and obviously we don't know when exactly they're coming, but when they come, new information comes and gets incorporated in stock prices pretty quickly. And so that's fact number one. Fact number 2, the churn rate of companies that are publicly traded is accelerating. So this Schumpeterian kind of survival of the fittest is a phenomenon that's always been there, but if anything, it's starting to accelerate. And if you look at the lifespan of firms, even the largest firms tend to have a relatively short lifespan. Okay, so that's fact number 2. Fact number 3, and this is one of the, I think, not celebrated enough academic paper by Hank Bessenbinder that came out in the Journal of Financial Economics not that long ago, 2018. And his research, I think, is kind of the definitive research in terms of long-run performance. And the results are quite stark. If you look at this chart, you see that lifetime buy and hold returns of all publicly traded stocks in the US. And by the way, I'll put a disclaimer here. A lot of the research I cite is US based. It is by market cap the biggest market in the world. It is an extremely popular market even for all foreign investors around the world. But I do want to say that a lot of the academic research has focused mostly on the US. And so just keep that in mind as I go through. But I truly believe that almost all of the findings I'm mentioning applies across the world. So Hank Bessenbinder, what does he find? Well, he finds that actually almost every stock ends up worthless. So if you hold a stock like randomly, if you pick a stock randomly, you have a very good chance of losing everything. It's just the way it is. And you see that there's a tail on the chart. There's a tail to the right. Oh, these are the big winners. These are the Amazon, Facebooks of the world that kind of keep growing. GE, famously one of the oldest companies publicly traded in the world. These over the years will really generate very high returns, but they are at the tail end. So keep that in mind. That's an important fact. Now, next fact, individual stocks are much more volatile than portfolios of stocks. And so you see this, and this is in every finance textbook, but there are plenty of academic papers on this. Campbell et al. Is a very famous one. And you see on the chart, the standard deviation is the volatility of a stock. And you see a very steep decline in that volatility as soon as you add a certain number of stocks in your portfolio. You see that even with 5 stocks, the volatility of your portfolio is a fraction of that of any individual stock. Okay, and then it kind of compresses after 30, 40 stocks. It's actually hard to reduce standard deviation further. Okay, you're left with what we call systematic risk, and you've diversified away all firm-specific risk. Fact number 5, so individual stocks can be extremely volatile. I mean, if the index makes you churns your stomach once in a while, once you buy individual stocks, then you really realize that things are volatile out there. For instance, Facebook, fantastic, phenomenally successful company, publicly traded, one of the largest caps in the world. Well, even for such a successful company, on any given day, especially days where there are big news, such as earnings announcements, you see these stocks can have dramatic swings. So Facebook, in this case, they missed the earnings. The earnings number were disappointing in July 2018. And when they announced Q2 2018, and the stock at 4 p.m., so just after the close, dropped 20% in after-hour trading. And you see the corresponding day on that chart, on that multi-year chart since they went public in 2012. That was one of the biggest dings that they suffered, even though in the long run, they actually did quite well for themselves. And so even stock portfolios can be volatile over short windows of time. And we really got a slice of that this year with COVID in February, March for the US market, and similar-ish times across the world. That is when the pandemic was declared as a global pandemic. And you see that the stock market, the indices, even the largest companies, dropped within less than 2 months by a quarter of their value. I mean, that is incredible if that's all your savings. In the long run, you see that you kind of see it. It's the last shaded gray area. It's a recession. We did have a recession because of it, while as we shut down the economy. But it's much less visible, I guess, as you see that in a long run window. So quick recap. Most market gains occur over a few days in a year. The churn rate of companies is accelerating. Most stocks end up worthless. Individual stocks are much more volatile than portfolios. Individual stocks are extremely volatile in short windows, and even portfolios can be volatile over short windows. So what do we do? What's the first conclusion? Well, clearly, several points to make. Investing in the short run is risky. We might miss these big up days. We might suffer from extreme volatility, whether it's earnings or any kind of short-term news that's negative for a given stock or the market as a whole. Diversifying seems to offer some benefits, and holding over a long period of time seems to make us sleep better. Okay, it's an important thing to consider. So we should probably diversify and hold on for a while. But there are many ways to do this. So how do we implement this? What's the action? Okay, at Babson, we believe in action. Okay, not just learning, but actual action. How do we do this in practice? And there's really two ways to go about it, especially as most of the crowd listening in are individual investors. You can do it yourself, or you can delegate. Okay, and so if you delegate, I'll just put on the first layer, which would be a wealth management firm, a family office, or your bank, generally speaking, or wealth management division of a bank, that will then take your money and invest it on your behalf into mutual funds, smart beta funds, hedge funds, private equity funds, venture capital funds, you name it. Okay. And so let's look at this. Let's look at the way we have to decide, and we have to decide how we're going to go about this. And so let's look at the evidence. And again, I'm going to focus on the academic evidence here. Okay, obviously, if you're delegating, you're bringing in the experts and you have to pay fees. That's what you pay for. It's the expertise, after all. So what can you expect from those investment professionals on average? Okay, that's the question we're really asking ourselves here. So, and as an investor, the benchmark is typically the market portfolio. Whether you're a professional manager or an individual investor, the market portfolio is kind of your benchmark out there. It's what the market does as a whole. This is a chart of the S&P 500, which is the index of the 500 largest US firms. But it's an index that's value weighted. That means the bigger the company you are, like Apple has a bigger weight in that index, the larger the fraction you have in that index. And just to give you a sense of these 500 largest US firms, they comprise about 83% of the US market today, okay, this year. Okay, so let's go and look in turn at what these asset classes have delivered for investors in the past. The mutual fund industry. Well, the mutual fund industry, I think, is at this point famous for underperforming. And there's just too many academic studies to cite here. A few classics will be Carhart 97, Vermeers 2000, Burke and Green 04. And what they show is that stock pickers exist, but there's only a few good ones. And on top of that, there's a lack of persistence of what we call the hot hand phenomenon. If you're actually good at it, if you have hot hands, you know how to pick good stocks. It's actually hard to repeat that performance and be consistent over time. And one of the issues that actually Burke and Green famously raised was that what happens is if you're very successful, you get known, the word gets out, everybody wants to get into your fund, you have a big inflow of funds, and in investing, there is a diseconomy of scale, meaning what happens when you suddenly have a $20 billion fund to invest, well, you can't be as nimble as before, okay? If you made your name by investing in small stocks, well, with 20 billion, you're going to move these stocks just by putting positions in each one of them. And so that's something to keep in mind here. And so this literature, you see the citations, they're a bit old, but academics tend, once the paper is out there, it's hard to kind of constantly update them and publish them, but there's a whole cottage industry of people obviously looking at the performance of actively managed mutual funds. And the latest Spiva report from S&P is rather sobering. You see that about 9 out of 10, 8.5 out of 10 funds underperform their respective benchmark, whether it's domestic funds, real estate funds, large cap funds, small cap funds. Almost, if you have 10 in front of you, 9 of them will not meet the benchmark, even though you're paying fees for them. Okay. So why do mutual funds underperform so much? I gave you some idea just before with this diseconomies of scale. One very famous academic paper that's very interesting is from Kremers and Petagisto in 2009, and they find that many mutual fund managers are closet indexes, meaning if you look at their shareholdings, their actual shareholdings, which they have to disclose in the US in 13F filings, you see that a large fraction of their holdings are not different from their benchmarks. And actually, if you look at the chart over time, you see that the percentage of the portion of their portfolios that is actively managed, that actually differs from their benchmark, is going down over time. And it's rather disconcerting given that you pay them on average maybe 1% annually of the fees, the assets under management. Rain or shine, they will take 1% of your fund when they are actually doing mostly what the benchmark is doing. It's a bit of a shame. Okay, and whatever they're doing leads to underperformance, which is a bit of a shocker in that front. So can we do better? Oh, there's a category called smart beta funds. Smart beta, what a wonderful marketing tool. So what are these funds? Well, they say, well, don't be too active. So they're more towards the passive investment vehicles. They're rule-based, meaning they have rules they follow, they track a given factor. It can be, so think of it as firm characteristics that some academics have shown lead to outperformance. So for instance, momentum stocks that have good momentum tend to continue. Value stocks that are trading at low multiples. So you pay only, the price to earnings is low. That means the price is actually low relative to the earnings power of the firm. High quality firms. How does that sound? Yes, that sounds good. So as measured by profitability measures, low leverage, growth, small size stocks tend to outperform in the long run. So why not have funds that really dedicate the investment to tracking these given factors that have shown to outperform in the long run in some cases? And I just gave you an example here, the Vanguard Value Index Fund. Many of them are ETFs, so exchange traded funds, which work similarly to mutual funds. And this one, again, looks at a value, so using these famous ratios, these like PE ratios, and try and select kind of stocks that are more on the value side than the growth side. So these smart beta funds actually have exploded in terms of the total assets under management following the strategic smart beta fund approach. But, are they worth it? And the evidence is rather mixed. Both the academic evidence on the actual performance of these funds and also conceptually. And here I'll just give you a sense of it. So a lot of these funds claim that they're basically passive and transparent. They tell you what's the focus of the fund and how they're going to invest, just tracking certain rules. But if you think about it, well, if you're going to look for value, so for instance, low price to earnings ratio, well, which multiple are you going to choose? And how many times are you going to rebalance? And there's plenty of questions like that. And so any given fund in, let's say, a value smart beta fund will have potentially wildly different performance relative to another value-based smart beta fund. On top of that, even though the academic research has pointed out to many factors that have over time shown out performance, there's actually a lot of academic research that shows that once these factors have been published, they tend to disappear over time, whether that's reversion to the mean or whether hedge funds look at the academic literature and then try and profit from it. The fact of the matter is typically some factors get in vogue and then they get out of vogue. And you can ask anyone who's invested in value in the last 10 years, they've grossly underperformed the index. Okay, so can we do better? Can we actually go to the world experts, the hedge funds? And so there, the hedge fund managers, interesting. First of all, the hedge funds, you just have to know that you're investing in very liquid, high fees. They're coming down, but still very high fees, and total black box. Typically, they have a website that you can't. There's just a website with a name, and there's a complete lack of transparency, which obviously allows for some gains. They sometimes report to different databases, like the HFR database, but we know there's end-of-year window dressing for when these hedge funds report. And so ultimately, well, do they underperform or do they overperform their benchmark? And so there, benchmarking these funds can be tricky because they have potentially strange exposures. But if you just look at relative to the S&P 500, you actually see a lot of orange on your right-hand side of the chart there. And the orange are the years where the S&P beat the HFR index, which again, the HFR index is an index of hedge fund performance based on many hedge funds that report to this database in terms of performance. So again, I'm not cherry picking any specific hedge fund. As a whole, they tend to underperform. Okay, and they keep disappointing. I think one of the big issues of hedge funds is what's the basic premise of a hedge fund? Well, they promise to deliver positive absolute returns in good and bad times. Hedge funds are meant to be a hedge relative to the rest of the portfolio. But if you look at the performance of hedge funds, they tend to not do so well in down markets. And we saw that this year yet again. And we've seen it in the past. If you look at the 08-09 crisis, you see that actually the hedge fund industry suffered quite a few outflows because they sorely disappointed in the last financial crisis. And so hedge funds have lost some steam, actually, and you've seen fees go down and you've seen their assets under management grow, but not anywhere as close to other asset management category. So there you see private equity, so it's a good segue. Let's look at the private equity and venture capital funds. Okay, and again here, they have similar characteristics to hedge funds. They're liquid, you have lockup periods, they have high fees, they're coming down. And again, they are not transparent. They typically invest in privately held firms. And so valuation is tricky. As long as there's no exit, as long as they don't sell the stock, it's going to be hard to gauge really their performance. But again, there's a lot of academic research out there. And many of them show that actually, as much as there are star funds, and the star funds tend to do well, there's a huge heterogeneity. And if you look at the bottom chart to your right, you see in green the star funds, the top quartile performance. And in red, the bottom quartile performance. So again, in red, it's the performance of 1 out of 4 VCs, in this case, venture capital funds. And you see that the performance is certainly not great and not on a par with the NASDAQ index. Okay, so what if I showed you this fund? So this is an interesting chart. This fund has quite a few stocks. It has Apple, Microsoft, GE, and ExxonMobil, among others. And what you see here is that it had a lot of GE and ExxonMobil 20 years ago, and actually in the last 10 years, it's reduced its positions in GE and ExxonMobil. Microsoft has been a core position, and it's gone up quite a bit in the fund in the last 3 years. And Apple was not in the fund 20 years ago, but it has steadily increased its investments in Apple over the last 12 or 13 years in particular. It seems to be pretty good at timing the winners and losers over time here. So that seems to be an interesting fund. What if I tell you this fund has picked every one of the 50 stocks that created the most value in the last century? What if I tell you that this fund actually also eliminates the underperforming stocks like Sears? They got kicked out of the fund in 2012 and recently filed for bankruptcy. What if I told you that it comes with no additional fees, it's extremely liquid, it's extremely transparent, doesn't suffer from any portfolio manager turnover issues, and it will still be there in 10, 20, 30, 40 years? What is this magic fund? It's the S&P 500. Okay, so I'll pause here for a minute. Just want to let this sink in. What I just described to you in the previous slides is the S&P 500. And one chart that we rarely see is a chart like this. And this is 4 of the positions of the 500 stocks, and it's among the largest 4 positions it's taken over time. But because it's value weighted, you see that basically as you become a winner, you take a bigger and bigger portion of the portfolio. And as you lose steam, like the oil industry, like General Electric, you become less and less of the index. And again, you see Apple and Microsoft of late picking up steam in the index as they outperform. And this is daily positions. There's no secrets as to what the S&P is based on. And again, it's value-based. So I think this picture, if there's any picture you should remember from this talk, it's this one. It's extremely powerful. And I think it's a picture I've never really seen to promote passive investments. And so that is the bottom line in my mind, is to really, really consider index investing. It's going to be very, very hard to do better than that by construction. Okay. And it's extremely easy to do. There's plenty of low-cost passive funds. Half of you said that you already are in them, and that's a good choice. You're not alone. If you look at the equity fund flows, you see that active funds are actually seeing huge outflows over the last decade, while passive funds have grown tremendously. So people have caught on. There are quite a few books talking about it. But I hope that today's presentation kind of highlights how hard it is to do better than the index by construction. And I think the other good news is that we said, if you look at stocks, we always say stocks is for the long run. Okay, but we also said that if you invest in individual stocks, most of them end up worthless. It's Schumpeterian economy, survival of the fittest. But with the index, you're guaranteed to have always kind of the winners of the economy in the moment. And so all these worries, COVID vaccine, this year, first and foremost, but you name it, wars, 9/11, all sorts of events that can be very damaging, even for an economy as a whole. These funds, if you invest in the fund and let time works its magic, you will outperform. Okay, so if you're going to delegate, you should delegate to the index selection committee and invest passively in an index fund. Okay, so now some of you are in the asset management industry. Some of you individual investors want to beat the market, want to do better, even though it's been shown to be probably the safest, smartest investment over the last century. I think we all have hubris. We all want to do better. We all think we can beat the market. And I think if you want to do that, that's fine. I'm one of them. But you have to recognize the challenge that is in front of you. Markets are efficient. They represent, we talk about the wisdom of the crowds being reflected in market prices. People are scouring, they're always looking for the next apple, including you if you are in that game. And so it's very hard to uncover things before others. So I'll just continue. I'll just give you a few rules if that's the game you want to play. Okay, so we agree. I hope I've convinced you up to this point that trusting an index is a very smart move here. And so this is kind of the main point of my talk, but you probably didn't want to hear someone say, just go and put your money in passive funds. It sounds too easy, even though that is really the advice of this talk. So this next few slides is really to hopefully give you some tips if you decide to not follow that main advice. So first, some useful rules. And I'll just summarize the 4 that I'm going to review in the next few slides. Beware of expert advice, especially when it comes to forecasting. And I'll show you a few examples. Then obviously you should buy low and sell high. And just like Warren Buffett, as he says, if you have to, if you sell, you have a tax consequence, and that means you also didn't pick the long-term winner. So if you have to sell high, and obviously buy low. And it sounds so straightforward, but it's actually extremely challenging. You should diversify, but obviously not too much, and I'll explain why. And then obviously you have to find the future winners, and we could have a separate lecture on that. But then you cannot sell them too soon. And I will emphasize that, because whether it's the index or individual stocks or any asset class, it's only over the long run that you're really going to make returns, the power of compounding returns. So let me quickly overview some of these, go back on these 4 rules, and then conclude and have the Q&A. So experts often get it wrong. And this is a beautiful chart that I will cover. It is really worth thinking about it. And I apologize for the small font. This is the forecast as of June 2014 of oil prices. And the green line is the realized oil prices. The yellow band is the low and the high for the major brokerage firms on Wall Street at the time. So June 2014, there were a lot of tensions in the summer of 2014 in Iraq. There were some disruptions. People were nervous. And so they thought prices would remain rather high. What happened, and you see a pretty narrow band between, and sorry, again, you can't read it, but I'll tell you, between $90 and $110. That was the band of expected prices for the next 2 years. The reality was extremely different, and oil prices crashed. What happened? Well, I'm sure many of you know in this audience, shale happened. The shale revolution in the US, which started off with natural gas, but then got applied to oil shale fields. And the US production doubled in 10 years, which is rather unprecedented in this day and age. And obviously that created somewhat of an oversupply. and hence, excess supply, prices go down. Now you might say, well, oil is a very special, tricky area. I will tell you just about every area. If you look at the survey of economists or survey of the major research arms of Wall Street, you will find constant disappointment in the forecast. Okay, so whether it's the treasury yields, whether it's the stock market, where many thought they would continue to drop back in March when it was actually the bottom. So just beware of so-called experts and recognize the randomness of life and markets. Buy low, sell high. It sounds so easy. Well, here's a shocking example. Peter Lynch, the very famous investor here in Boston who ran the Magellan Fund, generated 29% annualized return. Yet the average investor in the fund lost money. That's almost unbelievable. But if you see at what investors do, they do exactly the opposite of what I recommend, which is they buy high and they sell low. In times of panic, this is when the fund outflow is the highest. And this is something, it's very behavioral. It's the panic button. It's the risk off moment where everybody in the down market gets out when it's actually exactly the time to buy. And you've probably heard of the VIX index, the fear indicator, the volatility index. And what you see is that actually spikes in volatility, which is in 2009, 2001, in 2020, March of 2020, they're actually very good buying moments. And this is the famous adage on Wall Street, buy when there's blood on the streets. Sorry for the gory image, but this is kind of something that has proved itself over and over again. Diversify, but not too much. I won't linger on that, but you often hear common advice: never put more than 2.5% in any given position. Well, if you follow that advice, you have at a minimum 40 positions to go to 100. So you need to find and monitor 40 gems in your portfolio. So this is where the law of large numbers, the law of averages, will tell you you're probably better off with the index, because at that point, that's just too many positions that supposedly will outperform the market as a whole. And so, and you'll be in good company, actually, if you look at hedge fund managers. Some of the famous hedge fund managers tend to have these very concentrated portfolios, like Bill Ackman of Pershing Square. That's the only way they're going to try and beat the index. Obviously, this is high stakes game here, and you better pick the winners, which is a bit scary when you see Eddie Lampert, a very famous hedge fund manager who had so much into Sears Holding, which is one of the companies the S&P 500 booted out in 2012 and that recently filed for bankruptcy. This was a snapshot from a book I'm going to cite on the next slide. So it's in 2014 also, I believe, and obviously it's not a detailed, it's based on whatever public information these secretive hedge funds were willing to disclose, but it shows that they have this kind of concentrated approach. But then again, you better pick the best stocks. If not, you are grossly going to underperform the market. So pick the future winners and hold on to them. Well, easier said than done. Finding the next apple is really finding the next apple in a bag of lemons. And so the apple is there in the middle somewhere, but it's actually quite hard. There's an interesting book I'll just reference here called The 100 Baggers. 100 Baggers is a term to describe a stock that goes from $1, that returns, if you invest $1, it will return to you 100. So $10,000, 1 million. There's a few of them. There's about, I think the author collects 365 positions that actually delivered 100 times returns. There's some characteristics. Obviously, you have to pick them when they're still small. Buying Apple today won't get you there. Typically, the founder, owner, CEO, so the founder is still at the helm of that company, like Amazon and others. There has to be huge growth potential, so you have to kind of understand the trends in the global economy. The firm has to reinvest in order to tap into this growth potential, and obviously you have to have luck on your side. You'd be surprised at the mix of stocks that actually achieve that return. But the most challenging potentially is to not sell too soon. And so let me just talk a bit about that. And again, we could have a separate session to talk about how to really pick these winners. But one of the key challenges, if you're going to try and play this game, is to not only find the next Apple, but it's actually hold on to it until it actually really delivers on its return. So here's the last slide before my conclusion. Okay, and so Monster Beverages, I don't know if you know this company or not. These are energy drinks. It's an energy drink company. And actually, it's one of the best performing stocks of the last 30 years in the world. It's one of the fastest to achieve the milestone of returning 100 times the initial investment. If you had invested in the early days, in the first part of the chart on your right. But here's the kicker. If you look at this chart, you see a lot of volatility. And actually, if you don't see it, because we can't zoom in here in 0102, but there was a lot of volatility even in the first few years of its publicly traded life. There's actually many months where the stock dropped by more than 20%. Now, here's the question that I want to ask you. You've done the hard work. You've tried to find a gem. You found it. You found Monster Inc. And you know it's growing. It's hitting its stride, getting successful. If it drops 20%, if it drops more than 20%, think in 07, 08, think in 2012, do you sell? And if you sell, you're going to miss the compounding return. You're going to miss the big run-up that you get by holding on for more than 10 years this stock. And so, if you, and this is, I will ask you to do some introspection as to whether you can do that or not. If one way to help you, and it's actually appropriate given that Monster has cans, is served in cans, it's what we call the coffee can strategy. And you probably have seen that in movies or in different setup where you put a time capsule. So the idea is to take 10 stocks that you like a lot, that have already shown success, that have a lot of growth potential, good management, etc. Just put them in a coffee can, a virtual coffee can. Never look at them, only to make sure that the thesis still holds. Obviously, if things start going sideways for that company, you should sell. But as long as they're doing well, check every quarter when they announce results. How well are they doing? Are they on track? And if they are, even if they have bloopers once in a while, even if they're hit by COVID or the pandemic or anything, keep at it, keep holding them. And over 10, 20, 30 years, those would probably be your biggest earners. Okay, so I think my time is basically up before Q&A. So let me conclude. If you don't know when investments will do well, you should buy and hold. If you don't know which investments will do well, you should diversify. And the easiest and most effective investment strategy for the long run is really index investing. That will tick all the boxes at the lowest cost and most effective way. Or you can try to succeed where most have failed. And I wish you good luck however you decide to invest in your future. So I thank you for your attention, and let's have a bit of Q&A here.
Thank you very much, Professor. Thank you. So we have a few questions. The first question is from Uma, who is asking, how safe are hedge funds?
It's a good question. It's an excellent question. Hedge funds are not safe. I really want to. Their premise, again, is that they are safe, that they return absolute returns. They don't have market exposure, so they have low beta, and they do well in good and bad times. If you look at the performance as a whole, as an asset class, that is just not the case. That is not what they've delivered. And I think, Uma, I would say there's hedge funds and there's hedge funds. I mean, even within the hedge fund world, there's long short, there's macro, there's statistical arbitrage. There are many special situations. There's high frequency trading. So there are many types of hedge funds. And I believe that many of them are very risky. And in particular, they're risky in their governance, meaning they are not transparent. It's a black box, and you have to trust management. Some are extremely good, but typically those are not available to outside investors. Most of the superstar funds are closed to new money. So it's a challenge. Maybe another question?
Okay, so the next question is from Yusuf, who is asking, what are some of the good platforms to invest in international mutual funds? So basically investing from, let's say, from Kuwait to the US markets or abroad.
So I look forward to the day I'll come and visit all of you in Kuwait. I have never stepped foot in Kuwait in my life, so I'm not quite sure in terms of what restrictions there are on your end for investments. There are many platforms. I think one of the most for individual investors, Interactive Brokers is very well established. Interactive Brokers, and it allows you. It's a fantastic trading platform that allows you to do many things at low cost. And so I don't know if you have access to Interactive Brokers in Kuwait, but it's certainly one that I would ask you to inquire, Yusuf.
Okay, next question is from Saad, and he's asking, what do you think about international investment for either stocks or accommodation, small or huge investments for short and long term?
Okay, very good question. And my presentation was, as I said, a bit US focused. That's where a lot of the academic research is. So if you look at the S&P 500, it is a bit of an outlier. If you look at a lot of the indices across the world, and just even other Western countries like the FTSE 100 or the CAC 40 in France, they haven't delivered anywhere close to the S&P 500. And so there is a bit of a sense of the US exceptionalism at play. The US, if you look at the I believe today, 8 of the 10 largest companies in the world are American. And some were set up in dorms, like the famously Facebook with Mark Zuckerberg. So I think there is something special about the US, and I believe it's their governance structure. It's the rule of law. It's the drive to shareholder value maximization at all costs. So in terms of shareholder returns, US firms are extremely focused on the bottom line, and the legal system and so far the political system has been very favorable. Many countries around the world have lower governance, whether it's at the country level, where the rule of law is not necessarily upheld as well, property rights, etc. But my view is growth. The Asian markets and China is going to become Asian companies, whether they're from South Korea, Singapore, China, are going to emerge as among the very large firms. Think of Tencent, for instance, in China, is now a multi-hundred billions of dollars of market cap. And so I do think India, these are all growth engines. But remember, even if you invest in US stocks or US index, you're really tapping into an international growth. I mean, Google's money is made mostly abroad, not in the US. Same for Apple and others. So I think you have to think about how can you tap on this global growth, and in particular Asian markets that are growing fast as economies? They might be by investing directly in local companies over there, or it might be by choosing, I would say, global winners in that context. So always think of long term. Always think long term. Don't be very careful at moving short term. Buying. What happens when you start going short term or long term? When you start focusing on the short term, is that you typically start making mistakes. You're chasing returns. You panic and you sell quickly. You have to have a mindset where you are a co-owner of these companies. Let them do their thing. Let them solve a crisis. They're working for you. It's amazing. These people are working, the whole organizations are working extremely hard to make sure they'll survive the crisis, get to the other side of any crisis, and thrive later on. So I think the long-term mindset is extremely helpful when it comes to investing in stocks.
Okay, another question we have is from Adam. He says, thanks for the talk. Starting with the first principles of investing, what would be an ideal entry for a novice?
So I'm not sure what is meant by entry, whether it's a position, whether it's a book, whether it's an advice. Adam, I will say, well, I hope this talk was a good entry point, and you can play it back. It's recorded, and we'll have it available on the web. I think index investing is a safe place to start. Okay, it might go up and down. We know that even in indices, the Nasdaq dropped 20% in less than 2 months earlier this year. So you will have obviously your wealth exposed to risk, but it's probably a safe place to start. And then you start looking into individual companies if that's what you're interested in. You can invest in the S&P 500, but you can invest also in global indices. The MSCI World Index, for instance, a lot of passive funds have these, I would say, more global indices that then invest in the champions, not just the US champions, but champions around the world. And some of them are certainly emerging from places like India or China. Okay.
Raj says, funds using AI and quants, are they performers?
It's a good question. And I obviously I don't want to hurt anybody's feelings here in this audience. If you are one of them, there's always heterogeneity. In all of these asset classes, there are winners and losers. And so, when you ask me this question, Raj, the question is, is it a specific? We can always look at specifics. We can always look at a specific fund and their track record as a team and what they've done up to that point. As a whole, I would say, again, this is more like the smart beta quant funds. They haven't really outperformed the market. You'll find examples. So Renaissance Fund is probably the most famous example. That one has completely outperformed the market over the years, but it's closed. So again, the most successful are typically closed to new money. And Renaissance, we know, has been, it's all like physics PhDs and super quants, and they kind of devised very high frequency strategies to arbitrage, to profit from tiny discrepancies from what we call fundamentals. So there's little arbitrage situations that they can leverage up and do that through algorithms, through AI at a scale that allows them to put a lot of their money to work without moving the markets too much. So there are winners. You can find winners. As a whole, I'm quite skeptical of their ability to all profit from the same strategies. There's a notion of crowded trades potentially. So we know that, for instance, several hedge funds tend to have the same trades. So if they have the same trades, they move the market and they typically eat up the outperformance that's potentially there to to start with.
Okay, I think we have time for one more question.
Okay.
George is asking, are mutual funds with blue chip equity portfolios relatively safer within that universe?
Yes, they are. So that's a short answer. I know we're running out of time. Blue chip. So blue chip is a reference to the largest cap companies, and the largest cap companies typically are the safest. So that doesn't mean they risk and return in finance. They're the safest. That means they don't deliver the highest returns, but you will sleep better at night.
Okay, thank you, Professor. So with that, I would like to thank Professor Jérôme for his time and for his excellent talk. And I would like to thank everyone else for joining as well. And we hope to see you in future talks. Thank you very much. Good evening.
Thank you.